From the opinion pages of the Wall Street Journal, this is Potomac Watch.
It's a big week for the U.S. economy, which may be headed for some bumpy times. The Federal Reserve Open Market Committee meets this week and is expected to raise its target interest rate by another 75 basis points to stem 9.1% inflation. Then on Thursday, the Commerce Department reports on growth in the second quarter of 2022, which could be negative. That would be 2 quarters in a row of negative growth. What does all this mean for the economy and economic policy and politics going forward? Welcome. I'm Paul Gigot with the Wall Street Journal editorial page here with my colleagues Joe Sternberg and Kim Strassel. And let's start with the Federal Reserve meeting Tuesday and Wednesday, already having leaked that they're going to raise rates by 75 basis points. So there's not much doubt about that, Joe. I think it's unfortunate that they leaked that. I wish the Fed would stop doing that and would basically make their decision in the meeting and then surprise markets for a change. I think they could have a bigger effect on the psychology of the markets. I think you probably agree with that, Joe. But what do you expect out of the Fed this week?
Well, I expect a 75 basis point rate increase because that's what they've told us to expect. You're absolutely right that I do kind of have a problem with the fact that they've told us that. I mean, it's kind of worth remembering exactly how we got to this point where everyone just assumes that the 75 basis point increase is going to happen without even much thinking about it. Because this sort of started before the last meeting, a month or two ago, where they had put themselves on this track where they were going to be increasing rates by somewhere in the neighborhood of 50 basis points, half a percentage point at these meetings. And suddenly, right before the last meeting, Chairman Powell must have concluded that they were going to need more aggressive action because he started leaking strategically that actually a 75-point rate hike might be on the table. And sure enough, that was what happened. And the message at that press conference after that meeting and from other Fed officials was that we would see more 75-point increases. Well, a couple weeks ago, we get the latest inflation data, which are much higher than anyone had expected and suggest that what the Fed has done so far is not working. And there was a brief period of a day or two where people in the market started thinking, well, gosh, if the Fed is serious about fighting inflation, maybe they'll have to increase rates by a full percentage point at the next meeting. And the Fed basically came out and quashed that story, again, by speaking to our colleagues in the media, suggesting, no, we're going to stick to the 75 basis points. And that is the thing that I have the problem with, because I think that is a mistake for them to be so clear about what they will not do in pursuit of their inflation fighting goal. I mean, I'm kind of agnostic on the issue of whether it should be a 75 or 100 basis point increase at the meeting this week. I think it's a bad mistake for them to signal that there are some things that they will not do as they are trying to deal with this obvious inflation problem.
Even if they went 100 basis points, the real interest rates would still be negative. That is, they're below the rate of inflation by a substantial amount. So it's not as if we would actually have really tight money, only tight relative to where we have been. I agree, I'm agnostic on 75 or 100, but the markets have begun to wonder, I think, just how much further the Fed will go. The Fed is already running into political heavy weather here, Kim. We had an op-ed in our pages by Elizabeth Warren on Monday, essentially attacking Jay Powell, the chairman of the Fed, and the economist Larry Summers, who has, of course, opposed Fed policy for some time as too loose. Let's listen to Senator Warren talk a while ago to Jerome Powell in a hearing in Congress.
Inflation is like an illness, and the medicine needs to be tailored to the specific problem. Otherwise, you could make things a lot worse. And right now, the Fed has no control over the main drivers of rising prices, but the Fed can slow demand by getting a lot of people fired and making families poorer. So I just want to say, what's worse than high inflation and low unemployment? It's high inflation and a recession with millions of people out of work. And I hope you'll reconsider that before you drive this economy off a cliff.
So the heroic days of the Fed seem to be over, Kim, in terms of the political class in Washington warranting up Jay Powell as the villain if there happens to be a recession. Is she merely the vanguard of much more to come?
Oh, yes. The Warren argument here at the moment is that inflation is entirely about what's going on in Ukraine. This is Putin's price hike, both in terms of energy prices and in terms of higher food prices, which indeed have certainly been key drivers in the inflation numbers we've seen, although I would point out that we've seen inflation rising in a lot of areas beside that as well, too. And so her argument is if you raise interest rates, none of that is going to solve the problem that we are seeing in the Ukraine. And all you're going to do is cause employers to slow their hiring or cut hours or fire workers. This is about early blame shifting. Democrats already realize that the possibility of a recession is growing, and they want to be able to say when that happens that it is entirely on the Fed, all on Jay Powell. And I kind of find this particularly cynical, only because poor Powell in that meeting last month actually was saying, maybe you guys could help us out a little bit here too. There's way too much reliance on monetary policy, too much focus on demand management, and not on the supply side, the things that the administration could be doing or Congress could be doing to help companies grow and expand in this very uncertain time. And of course, Washington has been utterly unwilling to take any of those steps, whether you're talking about Democrats in the White House or in Congress. They'd like to just keep spending money. They want to regulate more. They won't deal with immigration and labor markets. But this is what's going on. This is an early attempt to blame it on the Fed, and the analysis is quite flawed. I
want to get to the supply side point here a little later, but this debate over monetary policy and its role in the inflation, Joe, is coming to the fore. And, of course, Warren in our op-ed attacked Larry Summers. And here's Larry Summers' response in a series of tweets. I'll read one of them. Senator Warren's attack on the Federal Reserve's monetary policy and my economic analysis are, I believe, misguided, and if heeded, could have devastating consequences for tens of millions of workers. And, quote, of course, Summers' argument is that inflation is eroding real wages and thus hurting the purchasing power of workers, eroding the standard of living. And he argues that the Fed doesn't do enough now to get this under control. Even if it causes a recession or contributes to a recession, the consequences down the road will be even worse if you let inflation persist. Who do you think has the best of this argument?
What's maddening about this is that they're both wrong for different reasons. So, I think that the core difficulty of all of this, and the problem that I have with the Larry Summers argument, is that so much of the way that the Federal Reserve and a lot of sympathetic economists, especially on the left, like Larry Summers, think about this is through the lens of the Phillips curve. This notion that we've been laboring under for decades, that there's a direct relationship between inflation and the unemployment rate, so that if you have higher unemployment, you will have lower inflation. And so that's kind of the origin of the Larry Summers argument that really the Fed needs to be putting millions of people out of work in order to combat inflation. And I think that Elizabeth Warren is not wrong to point out some of the problems with that argument, because, I think that a lot of this does have to hinge not just on monetary policy, but also ways that you could unlock the supply side of the economy so that you could have productivity increases even if the Fed was stabilizing inflation and prices. But, Elizabeth Warren is not exactly right about any of this either, because her argument is that the inflation is being caused by things that are entirely outside of the Fed's control. And the two examples of this that she cites, energy and food, are actually two of the things that are most directly within the Fed's control, because, so much of that is tied, commodity prices are tied to the value of a dollar. And if the Fed could stabilize inflation, could stabilize the value of the dollar globally, you would start to see those prices coming under control. In fact, commodity prices are often the canary in the coal mine if you're going to have inflation problems down the road. So I don't understand why her critique of so much of the rest of the center left's analysis of that is kind of excusing the Fed for some of the inflation that is most directly under its control.
All right, we're going to take a break, and when we come back, we'll have more on the inflation and the monetary policy debate. Plus, where is the economy right now anyway? Are we in recession, or are we headed towards one? We will talk about that when we come back.
From the opinion pages of the Wall Street Journal, This is Potomac Watch.
Welcome back. I'm Paul Gigot with Kim Strassel and Joe Sternberg. Kim, on this monetary policy debate, which is now becoming highly political, the big question in my mind is just how long the White House and Democrats will forego attacking Jay Powell if they need a scapegoat for the economy. And so far, President Biden has said that one of his planks of his anti-inflation policy is let the Fed go, let the Fed do what it has to do. That's the kind of forbearance that's hard for a president to sustain if the only other alternative is blaming you as president and Democratic policies. And of course, it's a bipartisan habit to blame the Fed when the going gets tough. I do think the Fed does bear quite a bit of responsibility for this inflation because they accommodated for way too long with essentially near zero interest rates and excessive bond buying. For too long, they kept that going through 20 and 21 during the pandemic, even as Congress was piling up something like $5 trillion worth of new spending and stimulating demand. And they, I think, implicitly bought into this view of modern monetary theory, which was a fad, basically the fastest repudiation of an economic fad in global history with this inflation we've seen. But it was the idea that you can run the deficit spigots as much as you want, and there really won't be a problem because the Fed can always accommodate it. And here we now see that inflation has arisen. So I guess the question I'm posed to you is, do you think the Powell Fed is going to stick with this as the political pressure grows?
Well, I agree with you that they do bear an enormous amount of responsibility. But of course, one amusing aspect of this is that if Democrats were going to have complained, they might have complained back then. Of course, they didn't because they were very happy that Powell and the Fed were accommodating their huge spending agenda, especially in 2021, when the signs were already really beginning to show that there was a problem. Last year really was the moment that the Fed should have been acting aggressively, but Powell was up for renomination. There was a lot of pressure coming in from Congress on both sides to do nothing, especially in 2020. Republicans were spending in their own right with Trump in the White House. So now we have the White House faced with this question of whether or not they will hold off from dumping on him and exerting their own pressure. I would look at Elizabeth Warren as the vanguard. She was laying the ground, as it were, I think, for the arguments that I do believe will start coming, whether or not out of the president's mouth, probably from advisors and anonymous quotes to the media about this entire situation.
All right. Let's talk a little bit about where we think the economy is now. Janet Yellen, the Treasury Secretary, who widely mooted to want to get out of town after the election. And one of the possible replacements for her, by the way, could be Larry Summers. Don't be surprised. Joe Biden likes Larry Summers. So you heard it here first, Sternberg. So Janet Yellen said that we're not in recession, even if the second quarter report this Thursday is negative following a 1.6% negative first quarter, that doesn't qualify as a recession. We have to wait for the National Bureau of Economic Research to put all the data together quite a bit after the fact to see if we are. But even if it's not technically a recession, the signs of slowing growth are all over the place. Very negative outlook from the National Federation of Independent Business and their small business survey. Leading economic indicators down again in June, fourth month in a row. Unemployment claims rising from 166,000 in March, weekly claims to 151,000 last week. That's still a low number, but the trend is not our friend. On the other hand, the unemployment rate is low overall, but that tends to be a lagging indicator. All right, Mr. Sage Prognosticator, Joe, where are we economically here? Are we in a recession?
I think that we're in an awful lot of trouble right now. I think that my theme for a while here has been that we are now firmly out of the stage of the inflation cycle where it's fun for people. Because the first year of an inflation cycle is often fun. Companies get to rack up very high nominal earnings. A lot of employees do see wage increases and, an opportunity to job hop and kind of catch up or get higher pay that way. The problem is that the second year which is about where we are now, is when the companies start noticing that their costs also are spiking and workers start figuring out that those nominal wage gains that they've racked up are not keeping up with inflation. And in fact, I think the last time I looked, the real wages, inflation adjusted, were declining by more than 3% year on year. I think you are starting to see signs that that is weighing on sentiment, and it's also going to start weighing on behavior. People are going to start buying fewer things because they will have less real disposable income available to spend after they've filled up the tank on the car, put food on the table. So I think that this is going to be a real issue and potentially a real test for economists like Larry Summers, who might get tasked with trying to pull us out of it, because they don't think that it is possible for the inflation and the recession to coexist with each other, even though that might be the kind of environment that we will find ourselves in.
Right. The risk, I guess, is even if this economy bumps along here at not quite a recession, 0 to 1% growth, that's hardly boom times. And then you have the fact that the Fed is really just starting to tighten in earnest now. Money supply is being reined in after explosive growth for something like 2 years. And that, as Milton Friedman, the great economist, taught us, tends to have an impact on the economy with long and variable legs, as he used to write. So that would mean sometime in 2023. So what you could have, Kim, is this era of stagflation to go back to, you're too young to remember this, but I remember it from the 70s, stagflation, where you had inflation and slow growth, kind of a miserable experience for everybody. And that's, I think, the argument for getting inflation done now and getting it back to the Fed's target of 2%, riding out whatever downturn there is, and then you can start anew with inflation no longer psychologically built in to the calculations of business and consumers. But I want to return here right now to the supply side point you make. If monetary policy is shrinking demand in order to control inflation, it would be nice to have some offsetting growth policies on the supply side. I didn't know that Jay Powell was a supply side aficionado, but apparently he made that point in his last meeting in Congress, as you pointed out. But what do you do? Let me give you some ideas, Kim. First, take tax increases off the table. Boom, out. Second, stop all new regulation here, a moratorium for Biden. No more added regulatory costs, particularly no new impediments to energy production. Unleash American oil and gas producers. Third, vote to extend the 2017 tax cuts, some of which expire in 2025. Take that off the table. That would be a signal for pro-growth. Does that sound like a Strassel agenda? And I know it's not going to happen now, but I think we have to start talking about this.
It's a winning agenda. Forget a Strassel agenda. It's a good agenda. And there are even some very specific things that could be done that would ease, especially those areas where things are hurting the most on consumers. Someone gave an example I saw recently where we are currently in the process, the federal government, of implementing this new diesel rule that involves reducing the amounts of sulfur in certain types of diesel fuels. If you were to back that off, it would probably have some sort of a marginal help in terms of fuel prices out there. Particularly, diesel is used to do most of the transport for goods and supply chains around the country. So there are very specific examples of things that administration could be doing. One other thing I'll throw out, of course, I think it's a bit optimistic given everything we've seen, but if Congress were to look at fixing some immigration issues we have, the labor market and hiring, that would be great. Then there's also the things I would just point out of things that Congress should not be doing, because it only potentially makes it worse, which is, of course, giant amounts of new spending, especially in areas where they're micro-directing industrial policy. Just this week, it's likely the Senate is going to pass a bill that could run $250 billion to give a big corporate welfare bailout to semiconductors and other tech firms. There's a veterans bill coming along, might be one of the largest and most expensive growth in veterans benefits in decades, that has to do with paying people in the military that were engaged in burn pits and the exposure, the health effects from that. You can go on and on. The appetite for spending in Washington hasn't receded at all, and this is not the time to be throwing a lot more money out the door. So there's plenty that everyone could be doing. But just to round this back, it's exactly why Elizabeth Warren, another reason she wrote that op-ed, and she was honest about it, saying that one of her concerns about where we're heading is that the arguments that Republicans will make that you need to deregulate, that you need to cut taxes, are going to gain ground. And that's exactly the opposite of what Democrats want to see happening out of Washington right now.
And of course, the economic uncertainty, decline in real wages, and slow growth when it arrives, if it hasn't already, will certainly play into the results in the election in November, where voters are saying the economy and inflation in particular are the most important issues. All right. Thanks, Joe. Thanks, Kim. Thank you all for listening. You can catch us tomorrow and every day here on Potomac Watch. Thanks for listening. Hope to have you back with us tomorrow.